Hello and welcome. This is Thank God It's Friday. Markets are in consolidation mode and there's a lot of uncertainty when it comes to various variables in India's economy. To take stock of all these things, we are in conversation with Mr. Neelkanth Mishra. He's the Managing Director and India Equity Strategist with Credit Suisse. Thank you for joining us back, sir.
Good to be here.
Well, okay, so I'm going to start with the fact that we've seen downgrades in FY18 earnings estimates, but your report mentions that the FY19 estimates have not yet seen a downgrade, but you are expecting that. You're also expecting muted growth for the next few quarters. Based on that, we're still looking at a lot of funds coming in from domestic institutions. Will these funds hold these markets, especially given the fact that we are expecting some amount of revision in earnings as well?
No, I think that's a great question. So let's look at it in two parts. One is earnings estimates, and the second is fund flows. Right? I think the drivers for both are very different. Right? So fund flows are a reflection of the fact that there is a rise in financial savings and a lack of demand for them, in the sense that government borrowing, aggregate state and central government borrowing, is not rising as fast. The loan growth in the system is not very strong, and financial savings are rising. And now you've seen even something that was would have been impossible to say or predict 2 months back. Savings rates are now down below 4%. I mean, that is something that we never thought would be touched, but has been touched. Shows that there is a surplus, liquidity surplus. Right. Now, in the absence of any avenues to invest that, it will find ways to get invested, right? And therefore, a lot of the money then comes to the stock market. That money may or may not generate good returns. So it is unwise to think that that is smart money, which is going in the right direction. What it does, because see, in any commodity, if there is excess supply and lack of demand, prices fall. So cost of capital comes down, which means lower interest rates, but also means high price to earnings ratios. Right? So that is one aspect of it. The second is the earnings expectations. I think India is like a house under renovation. There is a lot of structural change happening, which is disrupting the near term. But the hope is that this is all in the right direction, and there's no doubt about that. So people are leaving the FY19 numbers untouched. Right. So even for the first quarter GDP, after the first quarter GDP release, to the extent it can be trusted, the FY18 GDP numbers were brought down from like a close to 7 handle to a 6.5, 6.4%. Yes. But FY19 was largely left untouched. So people think that as the economy goes through these adjustments, it will revive very strongly. My fear is that that may not happen. At this stage, visibility is very limited, and I think that that's why people are being a bit cautious. But my sense is, and we have to take a view, in the market you have to take a view, you can't just stand on the sidelines. My view is that I think we'll see meaningful downgrades to FY19 as well. And I would not trust the flows to keep holding up the market, because the pricing is driven by what's happening to earnings.
All right. You also said that the current visibility is abnormally low as far as some of the macroeconomic parameters are concerned, be it the currency, inflation, fiscal health or growth. But Neelkanth, yet another emerging issue seems to be the lack of job creation, and that also, of course, will have implications for all your consumption-related bets.
That's right. So one big problem is that agricultural income growth is slowing down, and agriculture is the biggest employer. We have too many people in agriculture, and at some point they will get fed up with the low income growth and start moving out. The question is where. And the first output, the first port of call for them, for unskilled labor, is construction. 80% of construction is real estate construction, basically house construction. And because of the transitional impact of RERA, about the clampdown on black money, and the expectation that land prices will come down, and anecdotally they are starting to come down, and therefore real estate prices with a lag will start correcting, no one wants to invest there. And because of RERA, the new launches have slowed very sharply. So there are not even any construction jobs happening. The hope is that as the cost of capital goes down, it encourages investments. And for that, I think the rate cycle, the visibility on rates coming down has to improve. That at least some of the future investments start getting pulled back in. and that drives some job creation. But yeah, you're right. As of now, that is actually a big concern.
Actually, just one question, more of a follow-up. In your assessment, then what is the health of the rural economy also? Because a lot of people have been taking investment bets of late on, rural and agri-related stocks on the back of government's aim to double farm incomes by 2022. Of course, this year the monsoon started more on an optimistic note, but we're actually seeing many places which are reeling under a deficit right now. Plus, the rural economy has this tailwinds of demonetization that we're seeing. So, what is the state of the rural economy as?
See, the problem in India, because we're such a large and complex economy, is that we define the blocks at too large a level. Rural is like 70% of India, right? And to say, oh, rural economy is doing well or not is actually, I think, too broad a brush to paint it by. If you see two-wheeler demand growth, for example, it is now picked up. Now, what has happened is it could be because UP has implemented the pay commission and arrears are being paid. It could be because electricity availability, rural road connectivity, cell phone, data access, etc. have improved dramatically, right? So there is a pocket of the rural economy, maybe I will say the top 15-20% of the rural economy, which is actually doing well, right? So they are seeing better infrastructure, they are seeing opportunity. It is the farmers and the farm dependent part of the rural economy which is actually currently badly affected. So while it's about 45-46% of the workforce nationwide, in rural India it's about 65%. Right? So if you don't get farming right, if farm income growth is not good, then the rural economy on a broad-based basis will not do well. So you will still find at the top end of the rural economy, and it is a top end, like, so 4 crore, maybe, I mean, it's a broad estimate, but 4 crore out of 18-19 crore rural households have access to two-wheelers. So two-wheeler demand growth doesn't mean that rural economy is doing very well, right? We have to define the economy very appropriately. So yeah, so our view is that broad-based consumption, things like staples, cement, should continue to be weak. At the higher end, some of the discretionary items, and with better power availability, you can see better consumer discretionary sales. Like if a village only had 6 hours of power, there was no need to have a TV or a refrigerator. If you suddenly start getting 20-22 hours of power with an inverter, you can actually afford to have a TV, or you can have a TV or a refrigerator. So the point is, those sales may still do well.
Mm-hmm.
And you mentioned that there is very little visibility in GDP ahead. We've seen the April-June numbers, which were a surprise and not a very pleasant one. How grave is this concern here?
See, quarterly GDP, I must say, I mean, we used to criticize it when it was reporting very strong numbers, and I have equal doubts about the weakness as well, right? Because, see, India is not, it doesn't generate enough data to generate accurate quarterly GDP estimates. We only do it because IMF wants it, right? So I'm not too bothered about what 1Q GDP showed, right? I mean, I track it because people ask questions like you have asked, but I don't think it's very important. I'm more worried about the fact that oil volume growth is weak, power demand growth is weak, cement volume growth is weak, and the question is, when do they start to revive, right? And so there was a destocking-led element in the June quarter, and there was, I think, there has been somewhat of a restock in August. It's not as quickly as people thought. July was still weak, and I think that we will see some normalization by November, December. But the overarching theme of uncertainty is going to prevent new investments. There are, in addition to the stuff that Shraddha mentioned, there is also uncertainty on the banking side. So long-held problems which should have been corrected maybe 3-4 years back are now starting to get resolved. Now, as that happens, the banks are distracted solving those problems. The promoter groups that are affected are busy solving those problems. The other promoter groups are now eyeing if there is an opportunity for acquisitions. So no one is really thinking about fresh investments and money on the ground. And so that's again a correctional phase, but I don't think it'll get over in 6 months.
And again, on expected lines, we've seen tax compliance go up because of GST, but this also has brought some amount of uncertainty when it comes to India's fiscal. How does that play out?
Yeah, so GST is subsumes 40% of India's taxes, state plus center, right? So it's a big number. 10.6 trillion rupees was the estimate for FY18B, states and center put together. And we don't know, given how much the rates have moved around. I mean, the assumption is that the rates have been set close to where the earlier rates were. Right. But if you see actually the incidence, and we had plotted this for items in the CPI, there's a lot of move around that must have happened, right? And I don't think even the government knows whether there will be revenue neutrality or not. The challenge is, if you collect too much tax in GST, you act as a drag on the economy. You know, so imagine in a normal budget, if you had suddenly jacked up tax rates, people would say, oh, you're slowing down the economy, right? And this is exactly what's going to happen if you have set the rates too high, combined with the improvement in compliance that you're pointing to. Anecdotally, yes, there is a lot of evidence that there is improvement in compliance. Now, the point is, you will not get to know how much excess you have till you are well into the year, right? So July, the headline number looks good, but like half of it is IGST, right? And you're not clear if input tax credit has been claimed sufficiently. You also don't know, how much of it was just the GST build up in the inventory. So there'll always be some inventory in the economy, and that inventory will always have some tax imbued, right? It will be credited back when you sell it eventually. It's a consumption tax, right? So, so that could also be adding up to the July numbers, right? So I think it will be October or so, September, October, when you will start to get a broad sense of where the actual tax collection is going to be, and you will get to know that only end of November. By then, this year is over, right? And then the GST Council needs to decide by 15th of December as to what needs to happen, because the state government, central government will start preparing budgets for next year. So you can't be tweaking tax rates for 2-3 months. You have to do it for the next year. So this year's fiscal uncertainty is actually very high.
Okay. What is driving your overweight stance on metals and energy, both of which of course are more globally driven? Is it that you're more confident about the global growth projections, or is it the low PE and valuation bias which makes them attractive?
Both. So, these are sectors which underperformed for many years. In the last 1.5 years, they've done very well. One big change that has happened is that global growth estimates were being continuously revised down. So, if you look back the last 6 years, every year you would see the next year's growth numbers being revised down. In the last 1.25 years, 15 months or so, we've seen that those downgrades have stopped. In fact, what we are seeing is that European GDP has been revised up. The Japanese full-year GDP numbers have been revised up. China, to the extent that you can trust any of those numbers, I mean, the numbers have been revised up, even by a few decimal points. So the point is that global growth seems to be stable, which is why even the central banks, after a historic amount of easing, are starting to think about tightening, right? God knows when they'll tighten. The point is that they're starting to think about it. So there is some stability in global growth. And what has happened, especially in metals, is that there's been years and years of underinvestment. So after very record high capex in say 2010-11, when China was really booming, we have seen the last 3-4 years pretty much no capex happening. So that's what we saw in steel recently, right? So there's one demand spike, and suddenly everything moves up. So the steel smelting margins have moved up. Iron ore and coking coal have moved up like 40-45% in 3 months. I don't think it'll last. I mean, the seasonally it'll correct. But the point is, this shows there's a lack of slack in the system. And that gives me comfort. And these are also underheld stocks. Though they've done very well, I mean, they're still underheld. People don't expect this upturn to last, and which is an opportunity. In energy, we are mostly, I think, positive on the refining side, because similar dynamics are happening. As China curtails supply, they've curtailed it on steel and aluminum already, and even on refining, they're trying to consolidate capacity and all that. So as demand stays stable and supply growth does not happen, demand growth stays stable and supply addition doesn't happen, so refining margins should hold up. So everyone expects that refining margins will decline in the next 2 years. If they don't, then there is meaningful upside. And of course, low PE gives you some comfort.
You just spoke about the global growth stabilizing of late. But Neelkanth, there's also been this entire debate over how inflation targets globally are falling short of expectations, and that could again have implications for growth and the policies of some of these larger central banks.
That is why many have called it a Goldilocks phase, that you have stable growth, but inflation numbers are still low. So there is no urgency for the central banks to react, right? And that is one of the reasons why EM funds are seeing strong inflows, emerging market funds are seeing strong inflows. The resilience of commodity prices is also bringing some growth back to, say, the Latin American economies or even economy like Australia. And those inflows again are supportive of what's happening in India, right? So I think from the broader market perspective, despite our sort of cautious stance on the economy, I think there are pockets of growth in India which still should deliver returns. As I said, there is 15-20% of the economy which seems to be having good time. Airline traffic, car sales, these are doing very well. So those pockets, perhaps the stocks and sectors can still hold up. I think the overall market may not correct meaningfully if the fund flow keeps supporting it. But in terms of positioning within the market, which is where we sort of come in, meaning our value add to our customers is how to allocate funds within the market. I mean, the choice of whether to be in the market or not is actually pretty much not there. I mean, if some retail investor has given you funds to manage, you can't say take it back, right? So how do you allocate? And from that perspective, we are overweight IT. We think it's cheap enough, and if global growth stays stable, then at least the downside surprises should be taken off. I think I understand all the structural issues. I think I understand all the structural issues, but I think more or less they're priced in. So I think there is some value there. Metals, energy, we remain positive. We are also positive private sector banks and some NBFCs, because that's one sector where you can actually afford to see 3-5 years out, right? Because even if the economy does very badly, right? Even if even retail credit starts to slow down, and which I think may actually in a while, right. There is so much of market share to be gained from the PSU banks, and so you have very weak competition. I mean, I personally think that some of the largest private sector banks in India have terrible service, right? But the alternative is so much worse that you keep banking with them, right? And so what that does is it gives you good visibility for growth 3-5 years out. So even if they correct, people will actually jump in and start buying, right? And they may not do very well for the next 6-9 months, but over 2-3 years, I think they will.
Okay. You just mentioned that you're also overweight IT. Is this because, I mean, sure, valuations are low, but there are also growth concerns. And is this more to do with large caps, or are you looking at mid-sized companies as well?
Okay. The problem in IT, the problem, and the characteristic of IT right now is that 95% of the market cap of the IT sector is in 6 stocks.
Right.
Right. So if you really want to deploy capital, I will not punt on individual stocks, which people do PA anyway, but that's not the point. You have to take a call on the big caps. You can't avoid it. You can't say, I'm talking about the large 5% and I don't have a view on the top 6. So of these, we think that the large caps also are definitely, so they've stopped underperforming. I mean, that's generally a first sign of bottoming out. We cut our underweight in November, which may have been too early. We went overweight about a month and a half back. The point is that now even private equity firms are starting to sniff around. Right. Say, is there a buyout option? Because if your free cash flow yield goes to 6 to 8%, if your price discount to overall market goes to record lows, that shows that there is an opportunity. So some signs of a pickup in revenue momentum, and there could be a very sharp re-rating.
All right. Thank you so much for your time, Neelkanth. Pleasure talking to you. Lots of thoughts to take away, and a lot of rethinking that some of the bulls might have to do. But with that, it's a wrap on this edition of Thank God It's Friday. Thank you for watching, and have a good weekend.